Hello, this is 13 with Silk Trades, again with another video. We decided to do this one a little bit early since it's a pretty important subject and I don't think anyone should be trading options until they learn this. So we're going to jump right into it. On screen right now, this is our $500 to $10,000 account. We're currently at 2.2k right now. These are our positions right now. We're a little bit down on Moo. Everything else is pretty green. Down about $14 on Baba. Just bad entry points on our part. Let's look at a company though. Yeah, today was pretty slow. Just because of how bad my position was. Only made $24 on this account, but other accounts I got into a better entry since I'm focused on the other account more. Um, as we can see, Tesla's pretty down right now, so in terms of IV, it's been pretty high. Let's jump right into a contract and look at it. Okay, just for purposes, I do want to explain OTM, ITM, and DITM. Uh, Most traders that are going to be working for brokers, or firms, they're going to be looking at deep in the money to avoid any type of volatility. Whenever you get something that's right here at 255.18, this is at the money, okay? This is at the money right here. You're going to be looking at these. These are the Greeks right here. We'll go into that a little bit more. I just want to go over the basic understanding of what you want to get. So, if you want to play it more smart, you're going to get at the money or deep in the money. This is pretty counterintuitive to most people, or what they think is counterintuitive, because you're not going to be making any money if it's already in the money. It's just going to minimize that risk. It's not going to have any intrinsic, shoot, I can't say it, any intrinsic value, you know what I'm trying to say. Everything out here is going to have that type of value. These are all implied values. You're essentially saying, I think that Tesla will be 260 by October 12th. This has no value to it until that happens. You're basically gambling, which is, it's fine. We do a lot of these plays. We do a lot of small out of the money plays by one or two slots. That's totally fine. I like playing that way, but if you're thinking about doing safe plays, you're going to want to get deep in the money, which is probably going to be down here, or you're going to want to get at the money, or one up if you really want to have a little bit more risks to it. So let's go out a little bit more. So this is going to be the price per contract. The best way you can figure out the price is you just move the decimal to the back. So this price is 11,000 or $1,145 to get into it. Um, Open interest, basically how many contracts are open that haven't been exercised yet. Volume is very important to remember. This is how many contracts got bought and sold. We don't know the number. It's just a good indication of how active this certain contract has been traded. It's a really good number to look at. If you have TOS, you can look further into it. You can kind of see option volumes and what's getting bought, what's getting sold. Okay, let's get straight into the Greek. So right here we have a 0.5227 Greek. So actually, let's look at something that would make more sense. Since I already bought it, I can go over my explanation. So we'll be looking at SPY 287.5 calls. It's currently trading at 196. Today we got in at 141. We probably could have got into a better trade. We probably could have got around, let's see. I, uh, this is where I bought in around that time. I assumed this was bottom. That was my bad. We had a little pullback, and that's where I assumed we could start profiting. I could have probably bought at 136 if I just held on for a little bit, but all in all, I'm in profit. I'm up 40% on this trade, 55 bucks. That's pretty good. So we're going to be looking at this. This is going to be the stats and the Greeks. I didn't buy it at these. Just keep in mind that when you're looking at it, you want to look at exactly what you're buying. In terms of open interest, I look for stuff that has more than 1,000 open interest. So if I really want to get rid of a contract, I can sell it ASAP. If you're looking at an open interest that has only 100 open interest right there, as you can see the spread right here, right? 194 to 198. The spread's going to be a lot more wide if the open interest is going to be less. So, you know, you might have to buy at the ask, which is like 198, but for pretenses, let's say there was only 100 open interest for this, the ask might be like, let's say like 250, right? 250, and let's say the bid would be the bid would probably be like $2. So that's a 50-cent spread. You don't want to play anything like that because let's say even if you had a gut feeling it would go up, having such a low open interest puts you in the risk of having to follow whoever is putting up the ask price or the bid price. You won't really have a lot of flexibility in this area. With this open interest, you know, as you can see, you could probably buy at 196 right in the middle with a lower open interest. You have to buy the peak ask, so you have to already be at a loss because the bid's gonna definitely be a lot lower. So I just try and stray away from those. Volume was a lot more than open interest, so I took a lot of interest into this specific call. Seems like a lot of people are getting into it. Break even's 288.91, so we're not even looking at that far of a stretch. Alright, going into the Greeks, Delta. Probably going to be one of the most important things you should make sure you have a grip and a good understanding on is this is basically going to be 0.559. That means that this, every time it goes up a dollar, essentially you get 0.5559 increased to your contract price. So let's say SPY is what's SPY at? SPY's at 288 for this example, right? It goes to 289, you make $56 basically into your contract. Not 55 cents, you make $56. So every dollar, so we bought this almost at 287. So we bought this at about 287, right? And now the price is at 288. So there's our 55. There's our delta right there, right there. That's a pretty basic understanding of it. Gamma, it's not as important. This basically changes the delta when mu goes up or mu. So let's say SPY goes up a dollar, right? If SPY goes up a dollar, then 9.0945 gets added to the delta. So then the next dollar will have basically a compound. It'll keep adding to the delta, ensuring your profit goes up higher. So once this dollar goes up, and then let's say it goes up to 289, then this point 0.9 would go over to 0.09 would go over to this. Then I'd probably be making about $67 on every dollar move up for SPY. So that's why when you get into option trading, you hear people say, "Oh, the reward is unlimited," because potentially it very much well could be unlimited. You know, obviously if SPY goes up to like 300 bucks, you're gonna make a lot of money, but that's what it means. Okay, so to kind of recap, delta is how much money you get when SPY goes up. So $56 basically. I'm just gonna round it up to make it easier. $56. And then gamma is gonna be how much delta changes when SPY goes up. So if SPY goes up a dollar, then essentially $10 gets added to this number for the next run up. Okay. Theta is going to be probably the most important thing that I stress on the Greeks. It's very important to know how much money you're losing per day to really gauge what kind of risk you want to be taking. 0.21, that basically means every day your contract is going to lose $22 in value. So right now my contract's 196, so my contract's worth $196 in value. By tomorrow's market end, it won't happen all at once. You're not going to see like a huge drop. Uh, Basically, what's going to happen throughout the day, the time decay is going to just kind of eat at your contract. It'll take a dollar here, a dollar there. You know, no one really knows exactly, but by the end of the day, you should lose about $21 in theta. So that's basically going to be called time decay. That's what we mention a lot in our chat. Make sure you have a good indication on that. Uh, let's look at another option just so you understand how important it is. So October 10, let's look at October 10. Let's say you wanted to get a put in, you believe the bear market was going to continue today. There's a lot of volume for a lot of interest for 287s. This could also be, keep in mind, this could be people selling at the end of the day. This 20K volume and this open interest, people could have been selling this and getting out of it. But I do believe Tuesday will be a little bit red. I don't think anything really shows that the trend will stay. There's not enough volume. Anyways, theta for this is 0.31, right? So $32 essentially is how much you'll lose tomorrow. If you think about it, it's $89. You're losing already almost 40% of that contract. Why on earth would you want to play this contract? The only reason you'd want to play this is if you really believe that, you would hit your break-even price. I don't see it here, but oh yeah, 286. You would essentially say, oh, SPY is going to go down $2 tomorrow. I can sell this tomorrow. I'm not saying it's a bad play, but I'm saying is it's definitely a high risk play. Okay, so when you're looking at stuff like this, can you really afford to lose that much within a day? Really keep that in mind. That's what people call weeklies in the stock market. I try and avoid them. I try and go for like October 19, November 16. It really depends on you. You really want to protect yourself from that type. I can afford to lose $11 a day off a contract that I believe in because I know it'll reach the point that I want it to. Okay. Going down, we're gonna be looking at Vega. This one's kind of important. You're not gonna be really using it that much. It's better used for understanding implied volatility and also the IV crush. So this is going to be important to understanding if you're going to get IV crushed or if you're going to get a lot of IV value out of your contracts if they're going to be going up more. So right here we're looking at it. It's only going to be 0.11, 0.12 to round it up. So basically if the implied volatility, let's look at it right here. It's 14%, right? Now for SPY specifically, you're not going to see huge movements in this. You might see like 2% on the day change. But every cent or every percent that changes, your option price will increase by $1. So every IV that goes up here, you'll be getting $11, if that makes, or $12 to round it up. So it depends on what contracts you're looking at. So Vega, right? We're looking at 12, let's say 12, just for all pretenses. And we're looking at implied volatility right here, right? If the IV went up to 15%, your contract would increase by $12. So if this is pretty high, and it's in a SPY doesn't move that rapidly, so this is actually probably higher than most IV for SPY. Unfortunately, you can't see historical IV, but if you could, you'd be able to get a better gauge on that. You can time the market to try and get into a Vega that is pretty substantial and the IV is pretty low, and time it so that once you get up to an ER, if the price is trading sideways, you could literally benefit just off of implied volatility. This is a strategy some people use. I personally don't use it. I only make sure that the IV is not above 80% when I trade. IV crush is very possible. If this number goes back down to like a penny, you're basically screwed because that just killed a lot of value for your contracts. RHO, you don't really need to know this. This is just if interest rate raises, you really don't need to know this. This isn't that important. But basically, let's recap everything. Okay, delta is how much money you get when SPY goes up, so $55. Gamma is going to be how much delta will change when SPY does go up. Theta is time decay, so this is how much you lose on a day. And then Vega, which is pretty important, is going to determine IV crush and the implied volatility movement. Okay, so after looking at that, I hope you guys got a pretty basic understanding on it. If you have any questions, feel free to message me in the chat room. Uh, Once again, always look for contracts a little bit far out. Do not play weeklies. They're not going to be beneficial to you that often. Alright, signing out.